Today, we're doing a complete breakdown of ASC 860. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 860, how companies reported asset transfers was murky, creating confusion and inconsistency. For instance, a $100 million asset transfer could be treated in wildly different ways. Now, ASC 860 provides clear guidelines ensuring consistency and transparency. By the end, you'll grasp how ASC 860 revolutionized accounting for asset transfers. ASC 860 was introduced to address the variability in how companies reported asset transfers. Before this, similar transactions can be reported differently, creating confusion. The standard provides a consistent framework for recognizing and measuring these transfers, which enhances comparability and transparency. For example, transferring a $100 million asset is now uniformly reported, improving financial statement clarity. ASC 860 applies to any entity involved in asset transfers, effective for fiscal years starting after December 15, 2009. The most crucial requirement is that the transferor must derecognize transferred assets if specific criteria are met, preventing double counting on balance sheets. This ensures that a $50 million asset transfer doesn't appear as an asset for both parties. The transfer and servicing model under ASC 860 determines when companies can remove transferred assets from their balance sheets. The model assesses if the transferor maintains control over assets. It evaluates if risks and rewards of ownership have shifted. For interviews, understanding this model highlights your grasp of derecognition principles, crucial in accounting for asset transfers. Scope defines what ASC 860 covers and what it doesn't. Candidates often mistake non-financial asset transfers as covered, a classic interview trap. Knowing exactly what's included can mean the difference between a passing and a failing grade in real-world applications. Misapplying scope can lead to incorrect financial reporting. ASC 860 focuses on the transfer of financial assets, like loans or securities. It covers servicing arrangements where one entity manages assets for another. Repurchase agreements, or repos, short-term borrowing strategies, are also included. This standard ensures complex financial instruments are represented accurately on financial statements, aiding transparency and consistency. Recognizing these inclusions helps avoid costly reporting errors. ASC 860 excludes non-financial asset transfers, like real estate, focusing strictly on financial assets. Liabilities aren't covered, as the emphasis is on asset transfers. Inventory sales, another exclusion, fall under different standards. These exclusions prevent misclassification and ensure financial statements remain accurate. Understanding these boundaries is crucial, especially during interviews where common traps dwell on misapplying scope. Grasping exclusions helps sharpen your reporting accuracy. A transfer under ASC 860 is moving financial assets to another entity, like selling securities. It involves control and benefits shifting from seller to buyer. Sale accounting means removing the asset from the seller's balance sheet, affecting financial reporting. Recognizing transfer criteria ensures compliance and avoids errors. For instance, selling a $2 million bond requires proper derecognition, impacting both entities' financial statements. Mastering this definition aids in flawless financial disclosures. Servicing, crucial in ASC 860, involves managing assets like mortgages for another party. The servicer handles payments, defaults, and fund distribution, generating fee income. Correctly recognizing these rights affects revenue and financial statements. For example, a bank servicing a $500 million mortgage portfolio earns fees reflected in its income. Understanding servicing ensures compliance and precise disclosures, pivotal in financial asset management. This knowledge becomes invaluable during audits and reporting. Navigating edge cases in ASC 860 can be tricky. For instance, transferring a car loan between banks is covered, as it's a financial asset. Selling real estate isn't, as it's non-financial. Transferring debt obligations doesn't apply either, since it's a liability. However, servicing an investment fund does qualify. Knowing these nuances helps ace interviews and ensures precise financial reporting, avoiding misapplication pitfalls that often trip up candidates. Transferring financial assets is a core activity in finance, affecting liquidity and risk management. ASC 860 ensures these transactions are recorded accurately. Without this, a $50 million asset transfer could vanish from the books or be double counted, misleading stakeholders. Understand how this model clarifies financials and secures trust. The transfer and servicing model clarifies how financial assets are recorded when transferred. Using Meridian Corporation's $10 million SaaS contract as our example, we'll explore each step of ASC 860. This model ensures transparency and accuracy, critical for stakeholders relying on financial statements. Understanding these steps can prevent misstatements and ensure compliance in asset transfers. Meridian Corporation needs to determine if their $10 million SaaS contract involves a transfer of financial assets. This first step is crucial. If control shifts, it's a transfer under ASC 860. Misjudging this could lead to financial misreporting. Here, control of software and implementation services must be evaluated to ensure proper recognition. Conclude with whether control has shifted, critical for the next steps. Continuing with Meridian Corporation's scenario, it's vital to determine if the $10 million SaaS transfer qualifies for sale accounting. This impacts how the asset is derecognized from their balance sheet. Failing to meet sale criteria means the asset remains recognized, distorting financials. Conclude with whether the transfer qualifies as a sale, setting the stage for assessing involvement in Step 3. Now, for Meridian Corporation, it's crucial to assess any ongoing involvement with the $10 million SaaS contract. This could mean retained interests or obligations that affect financial reporting. Misjudging involvement could lead to errors in recognizing gains or losses. Confirm if there's any continuing involvement, which influences the asset's derecognition and sets the foundation for accurate measurement in Step 4. Meridian Corporation now measures the $10 million SaaS contract, ensuring all assets and liabilities are accurately reflected. This includes adjustments for any retained interests identified in Step 3. Misvaluation here can lead to misrepresented financials, impacting ratios and stakeholder trust. Ensure measurements are precise, as this feeds into the final gain or loss recognition in Step 5. Look for fair value, factoring in any involvement. Finally, Meridian Corporation calculates the gain or loss on their $10 million SaaS contract transfer. This step crystallizes financial reporting, ensuring stakeholders see true financial performance. Missteps here could mean misstated earnings. Confirm gain-loss reflects fair value and transaction costs, concluding the transfer's journey through ASC 860. Final output, an accurate financial statement entry, reflecting the true impact of the asset's transfer. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Understanding disclosure requirements ensures transparency. With ASC 860, knowing when to recognize and what to disclose changes your entire financial statement landscape. In ASC 860, initial recognition hinges on when risks and rewards transfer, not just control. Assets are measured at fair value, and any gain or loss is deferred if necessary. If you retain over 10% control, it doesn't qualify for off-balance sheet treatment. This prevents misstatement of asset positions. ASC 860 requires ongoing measurement of retained assets at amortized cost or fair value. If control changes substantially, reassessment happens. For instance, a change in market conditions can trigger remeasurement of retained interests. Non-recourse provisions are ignored unless specific triggers occur. This ensures consistency and accuracy in reflecting asset values over time. How assets appear in financial statements hinges on control. If it's not retained, look under loans and receivables or investments. Liabilities should show continuing obligations. Notes should explain the nature of involvement with transferred assets, helping analysts understand exposure to risks. This ensures transparency and helps stakeholders assess financial health accurately. ASC 860 mandates disclosing qualitative aspects of asset transfers to highlight risk exposure. Quantitative cash flow data is crucial for evaluating financial health. The nature of retained interests, such as potential liabilities, must be clear. Also, details of guarantees or recourse provisions directly impact risk assessment. ensuring stakeholders can accurately gauge exposure and potential impacts. Imagine a CFO transferring a $10 million asset while retaining 5% control. They recognize $9.5 million for derecognition and classify the $0.5 million as an investment. This CFO continues to disclose the nature and extent of retained interest, ensuring transparency. Market conditions are monitored for potential remeasurement triggers, ensuring the financial statements accurately reflect current asset values. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. This journey through ASC 860 will show the critical financial impacts at each step, from initial recognition to eventual derecognition, illustrating the subtleties of asset transfers and financial reporting. Transferring $1,200,000 in receivables to a financial institution allows Meridian Corporation to enhance liquidity. ASC 860 mandates recognizing this transfer by debiting cash and crediting accounts receivable. This entry reflects the removal of receivables from Meridian's balance sheet, impacting working capital and cash flow positively by converting receivables into immediate cash. ASC 860 requires recognizing a servicing liability when transferring receivables if the transferor continues servicing the asset. Meridian Corporation records a $75,000 servicing liability, reflecting its obligation to service the transferred receivables. The liability impacts the company's balance sheet, introducing a new obligation and demonstrating compliance with the servicing agreement. Interest income from the receivables transfer is recorded, as ASC 860 allows for recognizing income when continuing to manage the asset. Meridian Corporation credits $45,000 to interest income, reflecting the earnings from this financial arrangement. This recognition enhances the income statement, showcasing effective liquidity management and asset utilization. Expenses incurred for servicing the transferred receivables must be recognized as per ASC 860. Meridian Corporation records a $10,000 servicing cost, impacting operational expenses. This entry reflects the cost of fulfilling servicing obligations, reducing net income but ensuring compliance with legal agreements and maintaining the integrity of transferred assets. ASC 860 requires periodic fair value adjustments for servicing assets. Meridian Corporation increases the servicing asset by $5,000, reflecting changes in market conditions or asset performance. This adjustment, credited to gain on servicing assets, ensures the balance sheet accurately represents asset values, contributing to transparent financial reporting. ASC 860 mandates recognizing accrued liabilities to accurately reflect financial obligations. Meridian Corporation records an $8,000 accrued interest liability, ensuring all interest expenses are captured by period end. This entry highlights the necessity of precise liability management, contributing to the true and fair view of financial statements. Derecognition of receivables is crucial under ASC 860 to reflect the true transfer of control. Meridian Corporation removes $1,200,000 from accounts receivable, maintaining integrity in financial reporting. This final step ensures that the balance sheet no longer reflects assets not under company control, highlighting transparent asset management. Settling the servicing liability finalizes Meridian Corporation's contractual obligations related to the transferred receivables. By debiting the servicing liability and crediting cash, the company ensures closure of this obligation. This settlement impacts the cash flow, but more importantly, aligns with ASC 860's requirements for complete and accurate financial reporting. Every Big Four and investment bank interview on ASC 860 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 860 governs the accounting for transfers and servicing of financial assets. It ensures that companies properly recognize when assets are sold or transferred. This distinction affects balance sheet presentation and income recognition. A common mistake is confusing sale criteria with secured borrowing. Remember, the key is whether control has been relinquished. ASC 860 was implemented to provide clarity and consistency in accounting for financial asset transfers. It helps differentiate between sales and secured borrowings, impacting financial statements significantly. Misunderstanding these criteria can lead to misreporting liabilities. Remember, It's about ensuring accurate representation of asset control and risk exposure. To record a transfer under ASC 860, determine if it qualifies as a sale or secured borrowing. For a sale, derecognize the asset and recognize any gain or loss. For secured borrowing, continue recognizing the asset and record the liability. A key mistake is not evaluating the control criteria properly. If there's continuing involvement, evaluate if the transfer is a sale or secured borrowing. If a sale, recognize a servicing asset liability and derecognize the transferred asset. Misjudging this can impact reported asset values. Always assess the extent of control retained to avoid recognition errors. Under Indian accounting standard, derecognition focuses more on the risks and rewards of ownership, rather than the legal transfer of control, emphasized by ASC 860. This can lead to different accounting treatments. Always identify the differences in control criteria to ensure compliance with the correct standards. International Financial Reporting Standards focuses more on the transfer of risks and rewards, while ASC 860 emphasizes legal control transfer. This can lead to different derecognition outcomes. Misalignment with these standards can result in incorrect asset and liability reporting. Always assess the risk-reward transfer for International Financial Reporting Standards compliance. Start by determining if the asset transfer meets sale criteria. If it does, remove the asset from the balance sheet and recognize any gain or loss. A $100,000 asset sold for $120,000 results in $20,000 gain. Missteps occur when not considering all transfer terms. Always check the control aspects. Yes, ASC 860 covers the transfer of servicing rights, focusing on whether these rights should be recognized as assets or liabilities. The trap lies in failing to assess the servicing contract terms properly, leading to misclassification. Always evaluate the obligation to service and the benefits derived. Disclosures must detail the nature of transferred assets, terms, and ongoing involvement. Omitting these details is a common trap, potentially misleading stakeholders. Proper disclosures provide transparency about risks, rewards, and control. Always ensure that all relevant details about the transfer terms and company's involvement are disclosed to prevent misinterpretation. Understanding ASC 860 starts with its objective, ensuring financial asset transfers are correctly recognized and measured. It covers all financial asset transfers, like securitizations. Control is key. A transferor must relinquish it for derecognition. Financial assets include cash, receivables, and anything convertible to cash. Know the terms beneficial interest and participating interest, both crucial for recognizing cash flow entitlements. The transfer model is all about derecognition. It hinges on whether control is transferred. Servicing assets and liabilities are recognized based on fair value, depending on costs versus rights. Continued involvement requires recognizing related risks and rewards. Measurement begins at the transfer date and continues at reporting intervals. Regular reassessment of servicing rights ensures accurate financial representation. In interviews, clarity on control assessment is crucial. Know the indicators inside out. ASC allows more scenarios for asset derecognition compared to International Financial Reporting Standards. Post-transfer, the transferor's role involves assessing continued involvement. Detailed disclosure of transfers and interests is mandatory. Common pitfalls include misjudging control relinquishment. Recognize retained risks post-transfer and use practical expedients for minor servicing assets. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.